Good morning, and thank you for joining on short notice. Korean hours are about 90 minutes from the open, so I will keep this tight and practical. Yesterday, the KOSPI fell 4.9% and triggered a market-wide circuit breaker. On the same day, Samsung Electronics printed the largest quarterly operating profit in its history. That contradiction is the subject of this call. Our core message is in the title. We read this as a local positioning unwind, not the start of a global risk-off episode, and the evidence for that distinction is unusually clean. I will walk through what happened, why the volatility signal is telling us this is domestic plumbing rather than fundamentals, how the leveraged ETF complex mechanically amplifies today's close, and the one genuine counterweight on the tape, which is the SK Hynix ADR. I will finish with our probability-weighted scenario map for today and the specific levels and time windows we are watching. No house marketing today, just the framework. Let me establish the facts first. The index opened down 1.6% and fell almost vertically to minus 8.2 by midday, which triggered the market-wide circuit breaker. It then recovered about 330 points into the close to finish down 4.9. Note the sequence on the chart. Minus 2, minus 7.9, plus 5.8, near flat, minus 4.9. That is not a trend. That is a market whose price discovery is being dominated by forced and mechanical flow. Two more facts matter. First, the selling was concentrated. Foreigners sold 3.3 trillion won of cash equities, of which about 3 billion was Samsung and Hynix alone, while retail absorbed 3.5 billion. Second, the trigger was not a bad number. Samsung reported a record 89 trillion won of operating profit, and its first foundry turnaround in 3 years. When a record print produces a limit-style decline, the explanation is positioning, not fundamentals. The long lower wick on record turnover is the first tell that forced supply met real demand below 7,400. The overnight tape gives you both sides of today's argument. The bearish side: the Philadelphia Semiconductor Index fell 4.65%, driven by the Samsung read-across, a Morgan Stanley note recommending underweighting memory, and a Reuters report that DeepSeek is developing its own inference chip. Oil rose 5% after Washington revoked the waiver on Iranian crude sales following the Hormuz tanker attacks, and that pushed the 10-year Treasury up 7 basis points to 4.55. KOSPI night futures settled down 2.6, so the mechanical gap estimate is minus 1.5 to minus 2.5% at the open. But look at the composition. NVIDIA closed higher on the day. The S&P fell less than 0.5%, and most S&P constituents actually advanced. This was rotation, not liquidation. The VIX sits at 16. In other words, the overnight session was heavy in exactly one place, memory semis, and orderly everywhere else. Keep that asymmetry in mind because it frames the next slide, which is the heart of our view. This slide is the analytical center of the call. The VIX closed at 16.1. The VK KOSPI, Korea's implied volatility index, closed at 85.7. That is a 5-to-1 gap between local and global fear, and gaps of that magnitude carry a specific diagnosis. The shock is being generated and priced inside Korea, not imported. 3 observations supported. First, if this were a global AI repricing, U.S. volatility would not be dormant, and NVIDIA would not be green. Second, the Wall Street Journal article yesterday made our point for us. 165% one-year rally, concentrated in 2 stocks, carried on margin debt and single-stock leveraged ETFs. What is unwinding is that stack. Third, and most telling, the foreign flow split. Foreigners dumped 3.3 trillion won of cash shares, but were net buyers of index futures. Price-insensitive selling in cash against level-sensitive buying in derivatives is the signature of rebalancing and hedge adjustment, not of an exit from Korea. The investment implication? Positioning unwinds exhaust themselves, sometimes violently and quickly. Fundamental bear markets trend for months. Today, we treat this as the former until the tape proves otherwise, and we price both tails accordingly. Now the mechanics that make Korean closes unusual right now. The 2-time single-stock ETF complex, referencing SK Hynix and Samsung, has grown to roughly 38 trillion won of assets. The single largest piece is offshore. The CSOP Hynix 2X product in Hong Kong, at $16.8 billion, is now the largest single-stock leveraged ETF in the world, larger than Hong Kong's own tracker fund. The arithmetic of these products is simple and non-negotiable. To reset leverage, they must trade approximately 2 times assets times the day's return at the close in the direction of the day's move. The chart on the right converts that into won. If Hynix is down 3% at 2:30, roughly 2 trillion won of mandated selling hits the final hour. Down 5%, 3.3 trillion, which is our crash scenario trigger. But the flow is symmetric. Up 4% forces nearly 3 trillion of buy-in, which is how you get squeeze closes like last Friday's plus 5.8. One warning sign we flagged this morning. The CSOP product fell 15.6% against a theoretical 12.1, a 3.5-point premium collapse, and 13 of the 14 domestic products are underwater versus issue price. The retail leverage bid that fueled the rally is impaired. Treat the last hour of Korean trading as a different market. Against the leverage unwind stands one large, dated, and verifiable counterweight. SK Hynix's American Depository Receipts list on NASDAQ this Friday, July 10th. The order book closes today at 4 p.m. New York time. Pricing is tomorrow, and the book is reported oversubscribed by multiples of the offer. At an estimated $26 to $29 billion, this raise is comparable to an entire month of recent foreign net selling of Korean equities. The currency market has already voted. Offshore dollar won traded at 15.13 this morning against Monday's onshore close of 15.28. The won strengthened almost a full % overnight, and dealer commentary explicitly attributes it to ADR-related dollar supply, with Reuters reporting that proceeds will be partially converted into won by mid-July. 2 practical implications for today. First, there is a structural incentive for an orderly Seoul session into pricing. A disorderly print tomorrow morning would directly damage a $30 billion transaction. Second, and this is your cleanest intraday tell, watch Hynix relative to Samsung. If Hynix holds up better than Samsung this morning, the anchor is engaged. If Hynix underperforms despite the ADR event, the deleveraging flow is overpowering it, and the downside scenarios gain weight. Here is the framework output. We run a Bayesian scenario engine that scores itself against realized outcomes daily. Yesterday, it carried bear at 24%, and the close landed inside that band, so today's priors are updated accordingly. The regime is classified as crisis. The band multiplier is 3.5 times the call market unit, with an additional 1.8 asymmetry on the downside band, which is why the bear band runs all the way to -8%. Our rule requires it to contain the largest single-day loss of the past 5 sessions, which was Thursday's -7.9. The headline distribution. Base 33%, a heavy open that narrows into the close. Bear 29, bull 18, and 2 explicit tails, crash 13 and boom 7. 2 design points deserve emphasis for this audience. First, the bands are contiguous and exhaustive. Every possible close maps to exactly one scenario, so the model cannot hide from being graded. Second, after any session with an 8% intraday move, we force both tails open, because the day after a shock produces outsized moves in either direction more often than it produces trend. The honest summary? Modestly better than even odds that loss is narrow, but a 42% downside mass. This is a day for confirmation, not anticipation. Turning the map into rules. 4 levels define the day. 77.71 is the ceiling of the baseband and first resistance. 74.65 is the base floor and first support. 73.89, yesterday's low, is the single most important number on the screen. Hold it and the bottoming thesis strengthens with every hour. Break it and the bear and crash paths take over. 70.44 is the crash threshold. 3 clocks govern execution. From the open to 10:30, we observe and do not initiate. In a crisis regime, the first 90 minutes is where margin liquidations and stop losses clear mechanically, and yesterday's open to low collapse is the case study. At 10:30 to 11, we run the invalidation test. If the market has not printed a new low by then, and we see 2 of 3 signals, a touch and hold of the base floor, a session maximum volume spike, or a long lower wick from below -3%, the downside scenarios are declared invalid intraday and probability shifts to the recovery paths. And at 1430, the index level stops being purely informational. Hynix's print at that moment fixes the close auction at roughly 2/3 of a trillion won per percentage point. We treat the final hour as structurally distorted and make no fresh risk decisions inside it. What we are actually doing with this view. On the favor side, energy and refining are direct beneficiaries of a 5% crude move, and the defensive rotation, healthcare, food, financials, was already visibly working through yesterday's wreckage. On the memory leaders, we want to be clear rather than clever. The fundamental case is intact. Record earnings, the foundry turnaround, HBM4 leadership, and a heavily oversubscribed ADR are not the ingredients of a cycle top. But in a crisis regime, entries belong only at the band floor, only in scale, and only on confirmed triggers, not on the feeling that things look cheap. On the avoid side, we would not own any of the single stock leveraged products in either direction. The premium collapse tells you the wrapper itself is impaired, and its forced flows are the very distortion we have been describing. We would not chase yesterday's defensive winners after 8 to 11% moves, and we leave shipbuilding alone while an idiosyncratic 22% single-name shock is still bleeding out. On risk, cash at or above 50% while the regime classification holds. Hedges on both tails, because after an 8% day, the squeeze is as live as the break. And the discipline point. We will grade today on process, not P&L. Pre-committed stops and entry triggers beat conviction in a market where the marginal seller is a formula. Let me close with the 3 sentences we would trade by. 1. This is a local unwind, not a global shock. A 5-to-1 gap between Korean and global implied volatility says the stress lives in market structure, in leverage and rebalancing, while the AI demand cycle and Korean earnings power are intact. 2. The day is decided at 73.89 and at 2:30. Hold yesterday's low through late morning and the recovery scenarios govern. The 2:30 Hynix print then fixes up to 3 trillion won of mechanical flow into the close, in whichever direction the day is earned. 3. The ADR is the tell. Books close tonight, pricing tomorrow, listing Friday. And Hynix's relative strength against Samsung is your cleanest real-time read on whether that $30 billion anchor is holding. Everything on these pages is a probability map, not a promise. The framework will be graded against tonight's close and updated tomorrow morning, as it is every day. With that, let me stop and take questions. I know several of you will want to go deeper on the leveraged ETF mechanics and on how the ADR settles into the FX market, and we have time for both.